Alrighty. So in today's video, we're going to be talking about selling puts as a way to generate passive income when you're trading options. So this video, I'm going to give you a step-by-step guide. So even though if you're new to trading options, or maybe you've just been trading for, a few weeks or even a few months, you can definitely use this guide as well. So first of all, selling a put is the simplest way to generate passive income when trading options. Why? Mainly because there's only one option you really have to manage, right? If you're talking about trading spreads, for example, the popular credit spreads, or maybe the iron condor, or maybe even spreads like the broken wing butterfly and the strangle, those have many legs, right? You have at least two or more legs that you have to choose and manage. Whereas selling a put option, very simple, just one option you have to manage. So when you sell a put, you actually receive premium, and this is actually how you collect this, what we call passive income, right? Although this may not be the truest form of passive income, because the truest form of passive income is do the work once, and then the income will just keep coming over and over again. So basically, when it comes to options trading, selling put is one of the ways as close as you can get to receive this passive income. Now, when it comes to selling puts, there are actually two different strategies. So you need to be very clear on this because two different strategies, they're going to use slightly different mechanics from each other. And you want to be clear which is the one that you actually want to use. So the very first strategy that involves selling puts would be selling puts with the intention of owning the underlying. That means you want to own the shares, the stocks, or is it the index ETF, whatever the underlying is, you want to own the underlying, right? You want to get long the shares. So this strategy is also what you call the cash secured put, right? That means to say you want to ensure that whatever strike price that you choose, you have enough cash in your account to fulfill the obligation of getting those shares, right? At least 100 shares for each put that you sell. Now, strategy number two is selling puts with no intention of owning the underlying. So in this case, the strategy is what is called the naked put. So in this case, you're only selling the put option to get the premium, and you're not trying to get profit from the capital gains, right? For example, strategy one, not only do you receive the premium from selling the put option, the other way that you can profit is from the capital gains. That means once you get the shares, if the stock actually goes up, and then you can sell it off at a higher price from which you got assigned, you're going to profit on that as well. So these are two very different strategies, and it's very important that you know which is the one you want to go for at the start, right? Because the last thing that you want is to start out with one of the strategies above, and then you just convert it to the other somewhere along the line, right? Because if you're going to do that, it's going to mess up your strategy a little bit, especially because the mechanics we're going to choose going to be slightly different. So let's start off with the very first strategy. So strategy number one, and that is to sell puts to own the underlying. So for this strategy, the most important key factor to success is choosing the right underlying. So for this strategy, you're going to get the premium 100% guaranteed, right? Because all you got to do is sell the put option, just leave it there, right? Leave it there to see whether you get assigned. If you get assigned, you get the shares. But if you don't get assigned, then all you got to do, sell another put option, get the premium. So that is why the key factor to success for this strategy is choosing the right underlying, because once you get assigned, you have to ensure that the stock actually goes up for you to make money overall. So how do you decide what is the right underlying? So there are two ways to choose the right underlying, at least the way that I do it. So the very first way is to choose fundamentally good stocks. Now I know that there are many, ways to decide what is a fundamentally good stocks, many criteria. Well, basically I look for quite a few, but the main ones that I look out for, one of them is the income statement. I want to make sure that I see this, right? That the revenue is increasing over time, and that the net income is also generally increasing over time. Basically, I want to see that they have been profitable year on year. That's the most important thing. Because remember, all the stocks that we are trading, they are actually companies, right? So these companies are trying to make a profit. They're selling products and services. So if the company is actually not that profitable, or even not profitable at all, then it's going to reflect in the share price, right? It's going to reflect in the stock movement. So generally, if you want a stock to go up for the long term, especially once you're assigned on it, it's much safer to find one of those underlyings, one of those stocks that actually is profitable. Now, the other thing that I also look out for is basically the value of the stock, right? What is the fair value? Now, there are many different ways to calculate the fair value, so it's really up to you to decide, which way you want to calculate it, or, find the sites that you want. For me, a simple way to just, find the estimate fair value will be to go to use this site called Simply Wall Street. Now, there are many different sites that will tell you the valuation of the underlying of the stock that you're choosing. So you can just go and compare, right? But basically what I'm looking out for is that the current price is actually lesser than the fair value that is being stated on the site, right? So as you can see down here, the current price states is $346. But according to this site, the fair value of the stock is much higher, $527. So at least in this way, I know that if I'm going to get assigned, at least I know I'm putting the odds in my favor, right? Now, if you're not that good at selecting stocks, the other way is to simply go with the broad-based equity index ETFs, right? So for example, go with the QQQs, the SPY, or maybe the lower priced one like the X series, like the XLK, XLF, so on and so forth, right? So basically, these are what I call positive drift underlyings, where basically the market just wants to go up over time. Now, what you need to understand is that not all ETFs are made equal. So it's very important that you choose, basically the broad-based ones and those that is equity, right? You don't want to choose the one that's commodities, because commodities cannot keep going indefinitely up all the time. Now, next, the mechanics. So when we talk about mechanics, we're really talking about the DTE, the strike price selection, delta, premium, so on and so forth. Now, for this strategy, the mechanics isn't as important, because ultimately, the goal is to have your put option assigned and then get long shares. That means you won't be taking any losses on the put option itself. The only loss comes from the stock selection, right? So if you choose the wrong stock or the wrong underlying and the market goes down, then you're going to lose basically on the whole overall strategy, right? So the mechanics is not that important, but I'll just give you a guideline later on as to what I look out for. Now, next, if you're not very familiar with the term what being assigned means, then basically it just means that your put option is in the money and the buyer of the put option decides to exercise it. So once they exercise it, you'll be long 100 shares of the underlying per option contract. So as you can see down here, I just drew an example here. Let's say you have a put option down here, the market goes down, and this is what is called in the money, right? Anytime the price goes below your put option, your short put option is considered in the money. So at this point of time, anytime before expiration, there's always, the chance of getting assigned early. And if you're assigned early, then you will be long 100 shares. So now I want to give you a step-by-step guide for this strategy. So step number one, choose the right underlying. So I've already mentioned this in the previous slide. Now, once you've already chosen the right underlying, you want to ensure that it actually has options, right? Because not all stocks actually have options attached to it. So you may find, one fundamentally good stock, but you notice that they don't trade options. So if they don't trade options, then guess what? You can't sell puts. Now, if they do have options, the next thing you want to look out for is whether they actually have these weekly options, right? So it's going to be denoted with this W at the side of the date on the option chain. So most option chains should actually show it. And it's basically telling you there's weekly options, right? If there's weekly options, what it just means is that there's going to be more liquidity. That means more interest in people trading the options. So that's what I generally prefer. And the next thing you want to look out for is to make sure that they actually have a decent bid and ask spread, right? So you want to take a look at the option. You're going to open up the option chain and just look at the individual strikes. So you see the strikes, as you can see over here, this have roughly about 6 cents wide, 6 cents to 9 cents. And I think that's actually pretty fine, right? The one that you want to avoid is if they have very wide bid and ask spread. Let's say, for example, 20 cents wide, 30 cents wide, or even 50 cents wide to $1 wide. Then that's where you want to stay away from, right? So again, it's very dependent on the price of the underlying. So naturally, if you go for, stocks that is very expensive, like maybe 500 plus, 700 plus, then you're going to see the bid and ask spread, of course, going to be slightly wider. Now, step number two is to choose any DTE you like, right? So for this strategy, I'm not that particular about the DTE. Now, if you have been a follower of my channel for some time now, then you will notice that most of my videos, generally, I like to talk about the longer term DTEs, basically above 45 DTEs, mainly because we have an edge there. But there's a difference with this strategy because we're not trying to avoid assignment, right? We generally want to go for the longer term DTEs if you're trying to avoid assignment. But for this strategy, we actually want to get assigned, right? Because you want to own the underlying. So for this, it really doesn't matter which DTE you want to go for. You choose the one that you're comfortable with, but you need to understand the difference between the different DTEs, right? There's always a trade-off. There's not one that is better, because take a look at the one that is below, right? As you can see down here, there is 29 DTEs. So basically, the longer the DTE, the more premium you get. So as you can see down here, you get $2.82, which is $282 in premium for every option contract that you sell, because each option contract controls 100 shares. Now, if you go for the shorter DTE one, although you get lesser premium, so as you can see, this is the same strike, 135, you only get 57 cents in terms of the credit, which is $57 in premium, but you actually get a higher ROI. So as you can see down here, the ROI down here is 77.05%, whereas the ROI for the longer DTE one, down here is the 29 DTE, is 26.29%. So it's lower. So this is one thing to understand about the options, is almost as though like if you go for a bulk deal in terms of going for more DTEs, you're going to actually get it cheaper if you're the buyer, right? That means you can buy it much cheaper. But if the seller, it also means that you have to sell it for lesser return as well, ROI, right? But if you go for the one that is the shorter DTE, as you know, if you buy lesser things, it's going to be more expensive than if you buy, a bulk deal, like buy 100 of something, right? Compared to if you just buy 2 or something. So it seems that in the options pricing world, it's pretty similar as well. So although you get lesser premium, you get higher ROI. Down here, although you get, more premium, your ROI is lesser. So you might have the next question is, Davis, which one should I go for? Which one is better? And the only thing that I can tell you is that there is no one that is really better, because it really depends on the underlying market movement after you put on the trade, right? Let's say, for example, you put on the 2 DTE one. If you put on the 2 DTE option, you receive $57. And let's say the market goes down and then you get assigned at expiration. Then you could have said to yourself, hey, I should have sold the 29 DTE one. At least this way, if I get assigned, I got more premium, right? But let's say, for example, you sold the 29 DTE one and then the market goes up. But because the market goes up, you're still in the trade, it hasn't expired, you cannot sell another one. So you might have thought to yourself, you could have said, hey, I should have gone for the shorter term one because, after 2 days, the market goes up, it expires worthless, I can sell it again, right? As you can see down here, it's roughly about, let's say 60 cents, ballpark 60 cents, you get a premium. You can sell it how many times? If you sell it 5 times, you're going to get $3, right? And 5 times of this times 2 days, that's a total of 10 days. So in 10 days, you can get $3 premium. But whereas for the 29 DTE, you only get roughly about $2.90, right? So as you can see, this is the trade-off. This is the difference. Just choose one that you're comfortable with. All right, step number 3, next is to choose the strike price that is either at the money, which we call it ATM, or out of the money, which is OTM. Now, the nearer it is to the market price, the higher the premium. So the market price is somewhere down here. So on the option chain, somehow the number goes higher as, it goes down the ladder, which is so weird, but that's the way they design it. So basically the market price is somewhere below down here, right? 135, as you can see down here, is slightly below where the market price is, and 131 is what you call out of the money. So for this example, we will call 135 at the money. So what you notice is that, the one that's nearer to the market price, premium is higher, you get about $2.89, but you also have a higher chance of getting assigned, right? How do I know it's going to get a higher chance? Well, just by logic itself, you can deduce that if the strike price is closer to where the market price is, the market has, it's easier for the market to go down and then get this strike price being in the money and get assigned, right? Compared to the one at 131, the market has to go further down. Now, in terms of actual numbers for probability, one way you can find out is just by using this column down here called delta, because delta is also an indication of what is the probability of, the strike price being in the money at expiration. So if it's 45 deltas, it just means that there's a 45% chance of you being assigned at expiration. And for this 131 strike, there's a 28% chance of this strike being assigned at expiration, right? Basically, that's what it means. So it's always a trade-off. So the further it is from the market price, the lower the premium, but also the lower chance of getting assigned, like I mentioned. So again, once you're satisfied, send the trade in. So if you want an even more accurate way to find out, what's the probability of this underlying, getting assigned expiration, you can just open up this column down here, right? It's called ITM percentage. What it just means is that the percentage of it being in the money at expiration. So as you can see, the percentage is not too far off, right? If you take a look at the 131 strike, delta is 28. The percentage of it being in the money at expiration, 29%. The 135 strike, same thing. 45 delta, 45% chance of being it in the money, right? So you can use this information and then you can kind of, pick and choose your strikes, design your strategy accordingly. So last but not least, step number 4, once you already put on the put option, if it expires worthless, all you gotta do, rinse and repeat, right? Just sell the put option again. Now, if you get assigned, then this is actually what you want. Then at this point of time, you're already long the shares. You can consider selling a covered call, right? If you sell a covered call, then this whole strategy would have now transposed into what is called the wheel strategy. So I'm not going to go in depth into the wheel strategy because I already have several videos on it in my channel. So if you're interested, just go to my channel, do a search for the wheel strategy, and you'll find many that comes up. All right, moving on to the next strategy. So strategy number 2, this time we just want to sell puts just to collect premium. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. That means to say, as much as possible, we do not want to be assigned, right? Which also means that you probably have a smaller account, right? Generally, strategy 1, you do need a bigger account, depending also on the price of the underlying that you're planning to trade. But generally, if you're going to long shares, you need much more capital than, this strategy, because this strategy, you're not actually going to long the shares, so you do not need the capital to fulfill the obligation of buying the shares. For this strategy, mechanics are more important than strategy number 1, because since you're not planning to own the underlying, it's inevitable that you will have to take a loss on some of your trades, right? So this is something I talk about over and over again, is that when you're trading any option strategy, or at least strategies where, you're not planning to actually get assigned on the underlying, then sooner or later you're going to have some losses. So you need to know when to take the losses, right? If you want to always have wins, 100% winners, then good luck to you, because you're going to be in for, a very, very painful time. Next, for this strategy number 2, the sole profit driver is the premium from selling the put option, unlike strategy 1, like I mentioned earlier, where you have 2 profit drivers, right? Selling premium as well as capital gain. So for here, the mechanics is much more important, because we're only relying on the premium which we receive, or rather how much we can actually capture of the premium that we receive to actually create, this passive income for us. So timing your trade is also much more important than strategy number 1. So the key to success for this strategy lies in having the right mechanics, which I'm going to share with you, of course, and to have an edge and be profitable, net profitable in the long term. So again, the keyword down here I like to say is the long term, at least more than 100 trades or more, right? Because it's very possible that, if you have only like 20, 30 trades, you could still see a drawdown, right? You could still see your overall net loss. But if you continue to put the trade, as long as you stick to the mechanics I'll be sharing with you, then generally you're going to have an edge. You're going to be net profitable over the long term. So what are these mechanics, right? So I'm going to give you a step-by-step guide as well for this strategy. So step number 1 is to choose a positive drift underlying. So generally, what I mean by positive drift underlying, I just mean the broad-based index ETF. So generally for this strategy, I prefer index ETFs than to individual stocks, because they do not actually move as much compared to individual stocks, right? Individual stocks, many things can affect them. They have earnings, or they could have, very bad reviews, or maybe bad launches. So many things that can affect them, right? And if they are affected, especially to the downside, if it's negative news, the market can really tank, right? It can really gap down. And that's not what we want when we're trading the short put. So that is why I prefer positive drift vehicles like the index ETFs, where we know that over the long term, it wants to go higher. So as you can see, this is the S&P 500 at the top. Below is the tech index ETF, right? In this case, it's XLK. So again, up to you to choose which of this positive underlying that you want to use. Now, step number 2, this is where timing comes in. Now, you definitely do not have to use this, but this is just one of the ways, especially if you're getting started, a good way for you to, use as an indication of when you can consider selling your puts, right? Because if you're just going to randomly sell your puts on the chart, then what you may find is that although it's going to be positive drift, the market may go up in the long term, but during the duration that you choose for your option, the market could go down, right? And then even though the market goes up eventually, you're still going to lose on the trade because there's a limited timeline for which when you put on the option. So one way I like to help new traders get into the game in terms of timing is just use this indicator called the stochastic oscillator, right? Basically what it does is that it identifies overbought and oversold situations in the market. So as you can see, anything that goes below this purple line at the bottom is what's considered oversold. So at this point, you can pull out your technical analysis as well. You can take a look at support and any other indicators, right? If you want, basically once you see it's oversold, find some support, and then from there, you can consider selling your put option. Now, if you want to use RSI, that's fine as well. Now, if you're curious about what is my settings for this stochastic oscillator, I've already got a video that I've dedicated to the settings, how I set it up. Just go to my channel again and just type the word stochastic oscillator. You'll be able to find that video. Now, step number 3. So you notice in the strategy number 1, I didn't really bother too much about which DTE we want, right? I'm not that particular. But for step number 3, for this strategy, we must be particular because again, we do not want to be assigned. So for this, we want to choose anything that's around 45 DTE. I like to generally choose above 45 DTEs as well. And the main reason, as you can see down here, is because the study has already shown that there is no edge if you go lesser than 45 DTE. Now, if you're not familiar, I mentioned this in many of my videos as well. And I'm going to be repetitive, right? Because that's the way you can learn any single idea, right? Repeat it over and over again. So the idea down here is that to have an edge, we want the RM to be lesser than the EM. So RM stands for the realized move. That means the actual move that the market makes. And EM stands for the expected move, which is the theoretical move based on the option pricing. So generally, as you can see down here, if RM lesser than EM is good, right? That means you have an edge. If RM equal or more than EM, no good, right? Means we don't have an edge in the long term. So as you can see down here, this study is done on SPY, which is also another reason why I tell you guys to go for, those index ETFs, because a lot of studies have already been done on that, right? So why not just go for the ones that have already been proven to show that there's an edge? So as you can see down here, this last row, right, it shows the expected move, whether is it bigger than the realized move. So you notice from anywhere from 7 to 30 days, the one that I marked in the red box, the answer is no, right? Expected move is not bigger than the realized move. So this is not good, right? Because we want the expected move to be bigger than RM. But only when 45 days onwards, you notice that it says yes, right? Yes, and down here as well, 45 to 90 days. So that is why when we go for 45 days and above, then we're going to have an edge. So what does this edge actually translate to? All you got to know that is it translates to a slightly higher win rate than the theoretical win rate and net profitability in the long term. Now, next, step number 4 is to choose the strike price. So how do you know which strike price to choose? So generally, we want to choose a strike price that has a balance of, nice premium or rather adequate premium. And at the same time, we want to avoid being assigned as much as possible. That means to say we have the probability on our side that we're going to win more often than we actually lose. So as you can see in this case, we want to go for the delta that is around 20 to 30 deltas, right? So again, the studies have already been done on this 30 delta put option. As you can see down here, the win ratio, right? If you hold to expiration, it's 85%. And if you manage it at 21 DTE, basically you exit at 21 DTE, the win rate is going to be slightly lower, right? But what you want to also see is regarding the ROC, right? Basically, it's the return. Generally, the return is higher when you exit at 21 DTE. So this brings up the next step, which is to manage the trade at 21 DTE at the latest. So what happens if you hold the trade past 21 DTE? Basically, the risk increases, right? So there's such thing called the gamma. So if you're new to options, I don't want to confuse you, but what you need to know is that gamma is not good for us as a short option seller, right? So if you have a short put and if you hold past 21 DTE, gamma is going to work against us. We don't want that. So the latest is that once the trade reaches 21 DTE, you want to either roll it or close it, right? So this study down here, again, by the Tasty Trade team, as you can see, this study have been spanning for multiple years, right? Since 2006, around there. So you can see that all they did is that they actually just close the trade and put it on again, a new 21 DTE each time, the trade is closed for the 21 DTE one. For the expiration, once it's expired, they put on a new one again. And what you notice is that the 21 DTE actually has much better performance. So what they did for this study is that they just kept rolling it. Now, you don't have to keep rolling it. You can, of course, just time it as what I've mentioned in step number 2, right? So let's say, for example, you reach 21 DTE, you just close it, right? Whether is it a win or loss, you close it, wait until, if it's oversold again, conditions are met, or, whatever technical analysis that you want to use as well. You see that it's an entry, you enter again using the same mechanics laid out in step 3 and step 4. So you don't have to keep rolling it if you don't want to. Now, finally, step number 6, this is the most important one, and that is to manage your downside, right? To manage the risk on this trade, because the short put, what you need to understand is that it's an undefined risk strategy, which means to say if the market goes all the way to zero, you can lose a lot of money, right? That means you could actually lose much more than what you actually have in your account. So the most important thing is that because this is an undefined risk trade, it's important to set where your max loss is. So in this case, this is what I like to call your worst case scenario. So generally, I like to set it at the initial buying power requirement, BPR or BPE, depending, what your platform says. But BPE is basically, the amount that the broker holds for you to put on this trade. So let's say, for example, you put on a short put for this underlying down here. And this underlying, I just use an example, is Google. It gives you a buying power effect of negative 2,197. That means to say this is your initial BPR. So if the loss on this trade actually hits around $2,197, you want to exit the trade, right? Just close the trade, take the loss. So this way, at least you do not have one trade that wipe out your whole account. So one of the biggest mistakes that many new traders do is that they do not want to accept the loss, right? So they will hold on to the trade. So this is what I mentioned, at the beginning of this video, where some people, start off with strategy 2, but when the market goes all the way down past their put strike, they suddenly now want to switch to strategy 1 because they do not want to take that loss at around 21 DTE, right? So it's very important that around 21 DTE, you close it, but if it exceeds, right, your initial BPR, before this 21 DTE, you need to close it as well. Now, some of you might be wondering, what if I just set a stop loss that is smaller than the initial BPR? So let's say, for example, this BPR says $2,197. Instead of having your stop loss set there, maybe you want a stop loss at maybe $1,000 or something like that, right? Something much lesser. Well, if you want to do that, you can just do that at your own discretion. Why? Because studies again have been done by the Tasty Trade team. They actually examine the use of a stop loss when you're trading this short options. So as you can see down here, this is the study of the 16 delta put. And what they found is that while overall you're still going to be profitable, your performance when you're managing your losers, that means you cut off the loss at a certain multiple of your premium, you're still going to have a worse performance than if you hold to expiration. So if you see the previous slide, you can see that based on the annualized ROC, exiting the trade at 21 DTE, you're actually going to get a better performance than holding to expiration, right? You can see it down here as well. So if you were to put a stop loss, right, then you can see that the performance actually going to be lesser than expiration. So that means it's going to be far worse, right? But of course, I know that many people will have, will come and tell me and say, hey, Davis, but the way that I implement my stop loss is slightly different, right? Maybe I use technical analysis. Maybe I use a different multiple of my loss. Maybe I use a fixed dollar. all I can say is, hey, just go ahead and do that if you think that's going to give you a better performance. At the end, it's your money. I'm just going to give you the guidelines. So if at the end of the day, if you notice that just by managing, the losers that is smaller than the initial BPR, you get better performance, then by all means, go and do that. Again, most important thing, make sure it's objective, right? Objective means to say you do it across 100 trades, compare it to if you manage it at 21 DTE, and then see the results for yourself. All right, so this is how you sell puts for passive income, and I hope you found this video helpful. If you have, I would appreciate if you give me a thumbs up on this video. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.